Listen only mode.
Good afternoon and welcome to today's Premium Account Short Form Market Update. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading and listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, current Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. The format for today's presentation is a short form webinar, so we'll just do a quick summary of the global macro outlook driving equities. We take a specific look at the ASX top 50 companies that we've been active in or receiving dividends or selling call premium over the course of the last week. We tie that in with the financial year 14 earnings per share and dividend yield on those specific names only, and focus on the portfolio allocations in light of some of those recent transactions, and conclude with the short-term market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Moving straight into a graph of the Dow Jones. Now, I don't normally spend a lot of time on technical analysis, given that we're predominantly sort of fundamental data driven in our asset allocation. But in last week's recording, I just made notice that, or drew your attention to the fact that we had the accumulation signal in the Dow coming in on a higher low. So our target for the Dow was to see the index back down at around 14,500, which puts it on about 14.5 times forward earnings, subject to sort of where you see those forward earnings. If you're allowing for up to 10% EPS growth, you see that sort of fall down to around 13.5 times, but on current earnings at around sort of 15 times earnings. So that's about where we see fair value for the index at around 14.5. But interesting that we had this accumulation signal coming in on technically what's normally quite a bullish signal, a higher high and a higher low. So we started to see the market pick up last night with the Dow up 130 points. Interesting that the Nasdaq's had its highest close since September 2000. Also, just of note last night, just the restructuring of the Dow, where we saw Goldman Sachs, Visa and Nike added to the index. Bank of America, Alcoa and Hewlett-Packard were removed from the index. The picture with the US market's a little bit different to the domestic market. We have the ASX trading about 15 times forward earnings, with analysts looking for somewhere between, depending on what the analysts' numbers are, but generally the outlook for somewhere between 8 to as much as 12% earnings per share growth in the Australian market over the 12 months ahead. And that's a little bit disproportionate when you look at some of the names where we start to see, such as Macquarie, Asiano, CSL as examples, where we're looking for more than a high sort of single-digit growth. In some of those names, you're looking for sort of 20-odd% earnings growth over the next 12 months, where certainly at the other end of the market, we've got sort of, the banking sector, the ASX, and a few other names that are likely to deliver fairly sort of flat or benign earnings growth. Our base case for the Australian equity market is that we were looking for it to pull back over the course of this sort of September-October period, and we're looking for a late year rally from November into the early part of the new year. We've seen the Chinese data turn positive a little bit earlier than we expected. We're looking for that positive flow out of China recovery coming through around the November period. It appears that we're starting to get the early stages of stabilisation and improving retail and manufacturing data out of China, which is helping to add weight to the resource market. So I suppose combine that with the fact that we see that sort of more bullish structure occurring in the Dow. I tend to sort of think that if our thesis or analysis is wrong, it's probably on the side of erring on caution, and the equity markets may remain more buoyant than we anticipate. However, that all needs to be counterbalanced against the fact that the stocks on the XJO are trading at reasonably high multiples, and we've seen significant yield compression, and companies are already sitting at very high dividend payout ratios. So we're unlikely to see the big dividend boost that we've seen over the last 12 or 18 months. So I think, on balance, I'm probably more inclined to think that the equity markets are going to move sideways from these levels, albeit they'll probably stay within the top end of that range, not down at the 4,800 level that we saw the risk to the downside in the market sitting at. So on that note, let's just have a look at the stocks that we've been transacting in over the course of the last week, from last week's webinar to today. So Amcor is a name that we were buyers of at around this 10.25 level. The stock has gone ex-dividend. We collected roughly 25 cents for the $11 November calls, so we've got an effective exit price there in Amcor of around 11.25 into the end of November. I think that when you consider that on forward earnings allowing for Amcor to grow roughly 10% into 2014, the stock's on 16 times earnings and trading on a 4.3% dividend yield. I think this is one of those names that I've spoken a bit about, that we're pretty comfortable that the downside risks are reasonably limited in Amcor as a result of the demerger of the Australian packaging business, but it is reasonably full value, so we're buyers of it around this 10.25 level, selling up at 11, effective exit price of 11.25, and we collected the div, so there's a good return in trading Amcor within that range. The other name that we've been active in over the last week is Brambles. So we collected the 13.5 cent dividend after owning Brambles at around $8.70. The stock's gone ex-div 13.5 cents. This sort of fits into our theme of US dollar earners, where Amcor, Brambles, Computershare are names that we like from that perspective. To put some numbers on Brambles, the stock trades at around 15 times next year's earnings and on about a 3.8% dividend yield. Our strategy here is to own it at these levels. We've been selling the 9.25 call into November. We collected around 25 cents for that, and that's on top of the 13.5 cent dividend that we've just collected. I think the strategy is to continue to be owners of Brambles at around this level, and happy to be collecting the call premium up around 9.25. It's another company that we're looking for the spin-off of the recall assets coming into the December period, which will help to unlock some value for shareholders there in Brambles. Computershare is the other name that we have been active in. So again, we're fitting into this US dollar theme that we've been running. We've been buyers of Computershare down here at around this sort of 9.70 level. We've sold the covered calls at 10.25 into the end of November. We got 25 cents for those, so it's effectively giving us an exit price of around 10.50 into the end of November. From a valuation standpoint, what that means for Computershare is it's trading about 16 times 2014 earnings and at about a 3% dividend yield, and that's allowing for about 8% earnings growth. I think that's probably on the downside. We could see Computershare deliver low double-digit earnings growth, which would support a valuation back up at around 10.50. So I think we're sort of sitting in the right value range there on Computershare. Also, over the course of the last week, Lendlease, we collected a 20 cent dividend on Lendlease. We've been owners of this at lower levels. We sold the covered calls up at around 10.25 again into that November period. We picked up roughly 25 cents for those covered calls. So again, giving us an effective exit price there of around 10.50. We've collected the 20 cent dividend. I think from Lendlease's perspective, the stock's trading on a low PE of around 10 times next year earnings. The market's not pricing in a huge amount of earnings uptick. However, commentary out of the company seems to be turning a little more bullish. I think on the next 2 to 3 years, we could sort of see Lendlease continue to return its earnings growth up into high single-digit, 8 to 9% EPS growth, possibly even low double-digit earnings growth. But with the stock yielding around 4.5% and trading 10 times earnings, we're pretty comfortable that the downside risks are pretty limited there in in Lendlease. Also, we've been active in Toll, so this is another name that we've been buyers of it at lower levels. We've sold the $6 calls. We collected the 14.5-cent dividend just in the last week, and our strategy there, as I've spoken about in prior recordings, is to own it in the sort of low $5 range, happy to deliver it up at $6. From a valuation standpoint, Toll trades at about around 13 times next year earnings. It's on about a 4.9% dividend yield, and that's allowing again for maybe up to 5% EPS growth. So I think the likelihood of the stock performing much beyond $6 I think is reasonably limited. And finally, Woolworths. So it went ex-dividend this week, 71 cents. We'd been buyers of it at lower levels down here at around this 320, around 32.50. We predominantly sold the covered calls up around 34.50 to 35.50. So we're looking for the stock to finish September sort of pretty much around the range that it is at the moment. I think the issue here for Woolworths is, although the company's guided towards sort of 4 to 7% earnings growth, the stock's trading almost 18 times next year's earnings, and it's on a 4% dividend yield. So I think fair value for Woolworths is probably back at around this $33 to $34. So we own it at lower levels. We collected a good premium for the $34.50 calls, plus we've collected the 71-cent dividend. So it's giving us an annualized cash flow out of Woolworths well over 10%. And obviously allowing for some capital growth there as well. All the names that I've mentioned in today's recording is a combination of the dividend and the call premium. We're generating well over 10% of cash flow out of holding those assets and providing the opportunity for some capital growth from now through till November. And with a particular focus there on names that we see sort of limited downside risk because of either the exposure to the currency trend or the underlying earnings growth within the businesses. At a macro level in the market, I suppose, just to capture sort of one of the themes that have played out this week, as we've seen better economic data come through from China, we've started to see a small recovery in the resources. So when you look at the recovery there in BHP, Fortescue, this is all off the back of a much stronger iron ore price tracking sort of between, it's finding support at around 135 US a tonne and maybe trending back up towards the high 140s, which is much higher than where analysts had iron ore prices in their earnings forecast models, predominantly averaging around 125. So when you put in spot prices for iron ore, if they were to hold up at these levels, we could continue to see further upgrades to the earnings outlook to Fortescue. Rio, I'll just jump to that in a moment, so similar there to Fortescue we're seeing. So our target on Rio was really between $65 and $70. I think at around sort of $4.90 to $5, Fortescue starts to get a little expensive. We're looking for BHP to find support at or near these levels, with eventually sort of a stronger performance into the early part of the new year, which will see BHP trade back up towards sort of that high 38s to maybe $40 range. So the flip side of money coming into these risk assets or into the commodity names is we're seeing some of the yield names underperform over the course of the last week. So Telstra trading on about a 5.5% dividend yield into 2014. I think really what we're probably seeing is a rotation that will be reversed to the extent that we see further capital start to flow into some of these yield names again as they get a little bit closer to their dividend period. But as we start to see the US 10 years and in Australia the forward interest rate curve start to bottom out where the probability of an interest rate cut in November is diminishing, we start to see some of these yield names struggle to move higher. I think that's while structurally the probability of Australian rates going lower, I think is pretty small. Therefore, the argument for some of these defensive yield names is that unless they can deliver good earnings growth to support dividend growth, there's a good chance that they'll move into a sort of fairly prolonged sideways consolidation pattern. So we've seen a little bit of underperformance there in Telstra. We've seen some underperformance in Transurban, as we have in WDC and also in ASX. Now these are all names that we own, and we've really owned them on the basis that we're looking for them to largely move sideways and collect the dividends and collect the call premium. So whereas in the resource names we've purposely not capped those at low levels, we've allowed substantial sort of capital growth in those names, along with the ones I spoke about: Toll, Computershare, Amcor, Brambles and so forth, where we expect to see the uplift in the valuation of the underlying shares. So just to conclude today with a quick summary of the outlook for the equity markets. So whilst we see valuations fairly full, the reality is global bond yields still remain low from a historical standpoint. Capital's being forced into equity markets. We were looking for further volatility in September as a result of the German elections, issues in Syria. However, that doesn't appear to be playing out at this stage. So our base case is that equity markets remain buoyant and probably consolidate at the top end of our valuation range, and still looking for further upside in equities into the early part of the new year. Thank you for listening in. I look forward to speaking again next week.